Hello and welcome to this lesson on grain marketing through Illinois Advisor, one of several modules in a marketing education series brought to you by Illinois Soybean Association. My name is Jason Moss and I live and farm just outside of Quincy, Illinois in Adams County. I'm also a senior marketing consultant for Brock Associates, where I've worked with farmers, agribusinesses, other companies for around 15 years in commodity marketing. Our company, Brock Associates, was founded by Richard Brock in 1980, and we're largely known in the farm community and across Illinois by our most prominent publication, the Brock Report. Today's lesson is titled Hedging Strategy Part 2, wherein I will discuss futures options and different types of order entry that you can place. The thought behind Brock Associates working with the Illinois Soybean Association to develop and deliver marketing education to farmers stems from the overwhelming feedback that we've received that most farmers want to do a better job marketing, combined with our belief that market education is the best way to ultimately improve a person's marketing results. Now, it's very common for all of us as farmers to say that our number one marketing goal is to do a better job, right? To have the highest price possible. What's your goal in marketing? Just get the highest price I can. But really, better marketing results, or the best marketing results possible, is really a vision. Making better marketing decisions would be the goal, and making more confident marketing decisions would be the underlying objective you'd need to hit to meet that goal. Now, these video lessons in marketing education are going to get posted on Illinois Advisor, be accessible from all angles of the internet, which means they're going to get viewed by a wide cross-section of knowledge levels, experience levels, different sales levels, different reasons for listening, some pretty strong opinions, and probably a ton of different marketing priorities right now. With that, I just want to say that whether you make the marketing decisions and your motivation is self-improvement, whether you're just interested in the markets and your goal is to gain more knowledge, that the content of these lessons was designed to challenge your current marketing decision-making process and able to offer you some meaningful content. In the previous lesson titled Hedging Strategy Part 1, you'll know that we defined hedging, but we're going to restate it here because we're going to build on some of what we learned last time in this lesson. So to define hedging, the textbook definition in a Marketing 101 textbook is that it is, number one, taking an equal and opposite position in the futures market as one has in the cash market. So as an example, a soybean producer is long the cash crop, the physical soybeans that they're going to grow, and they would sell the futures price, or take a short position to protect the downside price risk of their production. Or a livestock producer is short the soybean meal for feed ingredient and would, to hedge, buy futures to protect their upside price risk of feed. Hedging is also establishing a price as a temporary substitute for what you're eventually going to do in the cash market. So you see, the very definition of hedging implies it's for those who do or will at some point physically possess the actual commodity. And you can kind of preview here that this is by definition indicating that how hedging works is always the integrated result of what's going on in both markets, the cash market and the futures market that you're hedging in. Hedging can also occur with options, which are puts and calls, buying and selling puts and calls, besides just taking futures positions of buying and selling futures, because all options are still just plays on what the futures price will or could do. And what do hedging with options do for you? Well, they can define price parameters with floors and ceilings for that selling price or that purchase price of the commodity, rather than outright locking in the price, such as when you buy futures at price X or sell it at a price. Like insurance, options allow for not being completely right or wrong. If you think of protecting price within ranges and giving yourself a worst case or best case potentially scenario that has a little flexibility built into that, rather than when you hedge futures contracts, that those are an accumulation to that average selling price on the total futures contracts. And lastly, with options, there are numerous trade-offs to allow for how you would customize that position. You're trading off how much premium you're going to get paid or receive. You're going to pay or receive, how high or low the floor and ceiling will be, how much margin will be required for that position, and how long the risk protection will be in place. And for some elevators who offer various programs or a typical min-max, if you've heard that name, type of contract, there's options that are underlying those contracts. And while they might show you, one or two possibilities, there are actually numerous different types of option positions, hedging positions that you could take that are all balancing a trade-off amongst these factors based on what's most important to you. What makes options as complex to understand for those who aren't working with them on a regular basis is that there's a second dimension to them. With futures, you buy or sell the futures, or you're buying or selling soybeans. With options, you are buying or selling the right to buy or sell. That second dimension of not just buying or selling, but buying or selling the right to buy or sell. So to kind of separate the different positions that you would take in options, depending on the type of hedger you are, look left to right. First, on the left, the short hedger, who is hedging downside production, which is the seller, which is the farm producer, by buying a put, first of all, is putting on a selling floor. And you sell at that strike price if the price moves below it. When you buy a $9 soybean put, you sell at $9 if the price moves below there. Selling a call would be establishing a selling ceiling, and you would only sell at that strike price if prices move above it. If you sell a $10 call, you would sell soybeans at $10 if the price moves above $10, and you would not sell anything if the price stayed below it. On the right, the long hedger or buying positions, those that are hedging the upside price, like users of the underlying commodity, soybean crushers, feed mills, etc. Buying a call establishes a buying ceiling, and you would buy at that strike price of the option if the price moved above it. If you were to buy a $10 call, you would purchase beans if the price moved above $10, and you would not purchase anything if the price stayed below it. Also, selling a put establishes a buying floor, where you buy or go long at that strike price of the option if the price moves below it. If you were to sell a $9 put, you would buy or be long soybeans if the price at $9 if the price moves down into the eights, and you would not have a position if the price stayed above 9. This is an itemized set of lists that look at the advantages and disadvantages of hedging with options. Advantages would be that you're setting price protection parameters within ranges, that there's less margin required than futures. Now, this would depend on the type of options hedge that you're putting on. By less margin required than futures, that would be the case for purchasing an option, or if you were to sell an option that's distant ways away from the market, the position would start at least with less margin required than futures. Another advantage, that it can be more forgiving with an unfavorable futures price move than if you were to just buy or sell futures. Buying a $9 put, if you're wrong and the price goes up, would if it goes up enough, would be better for you than if you were to sell the futures at $9 and the price went up the similar amount. It's also potentially a lower risk form of hedging in cases where you're simply buying an option. Just buying a put or just buying a call is a lower risk form of hedging because it has limited risk of what you pay for the option. On the disadvantage side of the ledger, number one would be complexity. That really, dealing with puts and calls, it's kind of a side of hedging that a lot of people are interested in, but unless you're dealing with them on a regular basis, they can seem pretty complex on how the value of the options change and a number of other factors. It's also higher cost form of hedging than futures, and I will put the caveat that that's potentially higher cost. If you are in a case where you're buying a put as a seller, if the price is at $9.50, selling the futures at $9.50 versus buying a $9.50 put for 30 cents, that would be a higher cost form of hedging by buying the put. Next, there's a time value cost of exiting early. Now, I like to tell the guys that I work with, if you calculate the net selling price within ranges of let's say buying a put, or maybe you sell a call with it, and the math on the way that works in calculating your floor and your ceiling and what your selling price is, depending on what the futures price does, that math doesn't lie, but in order for that math to come exactly true, it takes that position being on until expiration. And if you were to buy an option or sell an option in the market moved, let's say if several months ahead of when they expire, to get out of that position early, there would be a penalty you might incur for exiting early. And lastly, less adequate protection hedging with options than futures. I'll also say potentially, and that would come back to the same scenario of selling the soybean futures at $9.50 versus buying a $9.50 put for 30 cents, which would give you a net floor of $9.20. That difference, that's a little less adequate protection by having a floor at $9.20 versus selling it and having a futures hedge at $9.50. This illustration does a good job of explaining how the value of the options change based on what the price does by looking at what the gain or loss on the option would be at expiration. Now, all of this is before any premium paid or received. This is just an illustration of the value of the option being in or out of the money. So the way we look at this is the short hedger, or the seller, who's hedging the downside price risk, is on the left. And as I said earlier, they're buying a put to put on a floor, and they may or may not sell a call to establish a ceiling. And the P&L above $9 or at $9 or higher, the loss on buying a put is limited to the premium that you pay for the option. Below $9, you're establishing a floor. You are penny for penny gaining by the amount that it's underneath it. At $8, buying a $9 put will have a $1 gain on it. And again, these are before any premium, factoring in any premium paid or received. By that I mean, if I bought this $9 put for 50 cents, the price moves to $8, I would have a $1 gain, or the option would be worth $1 at expiration of 8. However, if I paid 50 cents for it, my net gain would only be 50. The second one, in selling a call, selling a $9 call, so I'm receiving premium, the gain is going to be limited to the premium that I receive by selling it at expirations of $9 or lower, and penny for penny, selling a call, establishing a ceiling. Penny for penny, I would have a loss by the amount that it is higher than $9. On the long side, on the right, the long hedger, who hedges upside price risk, can establish a buying ceiling by buying a call, or a buying floor by selling a put. And by buying a $9 call, the gain would be penny for penny at $9 or higher, and below $9 my loss would be limited to the amount of premium that I pay. And lastly, selling a put, selling a $9 put in this case, my gain would be limited to the premium received above $9, and the loss, since it's a buying floor, would be penny for penny, going against it below $9. So just to kind of recap and look across each of these scenarios, buying a put gains penny for penny below the strike price. Selling a call gains below the strike price, but only by the amount that you receive in selling it. Buying a call has a gain that's penny for penny above the strike price, and selling a put has a gain above the strike price, but with the limit of the amount of premium that you receive. This slide is going to visually illustrate the differences between a few different types of hedging strategies or positions you could put on, and then I'll kind of discuss why you might choose one or the other. But to lay out the cases for these, I'm going to throw up some prices in a second, but the blue line is buying a $9 put. The red line is buying a $9 put and selling a $9.50 call, floor and a ceiling. And the green line is buying a $9 put, selling a lower $8 put, and also selling a higher $10 call. And so for the purposes of this example, the black line here is also the futures price, and the futures price here is $9.25. And some costs, as I put up here in the top right corner for the example positions that are colored there. The futures price $9.25, the $9 put, a cost of 50 cents, a $9.50 call, a cost of 50 cents, the $8.50 put, a cost of 25 cents, and a $10 call, a cost of 25 cents. If the futures price is at $9.25, just for the purposes of this example, it's saying a put 25 cents underneath the market is worth the same as a call 25 cents above the market, and the $8.50 put and $10 call the same price, each of them 75 cents away from the futures price. So, why would a person do one versus the other? It kind of relates to what your net selling price will be, and what you combined with what your price forecast is. And if you look at what each of these does for you, from left to right, you see that the futures price starts out as the highest net selling price for a while. So at a certain point and lower, just selling the futures price is going to give you the highest net selling price. The futures at $9.25 is the highest at all soybean price outcomes that are $9.25 or lower. So the other ones seem to rebate some upside potential, and like I said, for giving you some flexibility, allowing for more forgiving in not being completely right or wrong. And the red line there is buying a put and selling a call in a pretty tight window, buying a $9 put and selling a $9.50 call. That has a lower selling price than futures of 25 cents all the way until we get at $9.25 and higher. There's a short stretch there where it has the highest selling price overall. It's the highest between $9.25 and $9.75. The limited collar where you're buying the put and selling a lower put and a higher call, has the best or highest selling price from 975 to 1025 because that ceiling is higher by selling a $10 call instead of a 950 call. And the last option here is just buying the put. And as the definition of buying a put, where your loss is limited to what you paid for it, well, if the price moves high enough, just having bought a put with no ceiling will ultimately give you the highest net selling price. In this case, based on the prices of these options, the put gives you the highest selling price at 10.25 or higher. So if the price moves high enough, the put is going to give you the best selling price. But to answer the question, then why wouldn't you just buy a put? And the answer is, look at all of the outcomes, below 10.25, where the blue line is not the highest. Take the red line, for example, the collar, buying a put and selling a call. By buying that put, I raise my floor by the amount of the ceiling that I'm selling. By the blue line, just buying a $9 put, or the red line, buying a put and selling a 950 call, my price rises from $8.50 to $9 on my net floor by the net cost of the position overall. So if you don't deal with options every day, or this seems a little complex, this is a marketing educational module. You can rewind it, you can look at it, you can use this for reference, but these are some fairly common types of hedging strategies with options, combined with looking at the futures. And just based on what your net selling price is at expiration, kind of tells you the differences between them and why you might choose one over another. There are several different kinds of orders that you can place for buying or selling futures or options. And the types you use do say something or characterize your approach to hedging, the type of strategy that you employ. But first, your major order types, most common, are market orders, limit orders, and stop orders. And I'll show some examples in just a second. Those have to do with where the market is in relation to the price of the order that you're going to place and what's going to trigger it. There are time specifications on the types of orders. Most are day orders that work for that trading day unless you specify otherwise. A good till canceled order is one that remains open until you cancel it. So if you put in an order to sell 5,000 bushels of soybeans at $11 on the November 2020 soybeans, that's going to remain open in an active order that could trigger until the end of 2020, the end of October in 2020, when those would expire. And there are secondary order types. OCO means one cancels the other. If you were to put in an order to sell some beans at $9.75, if it goes up, or to trigger selling it at $9 if it goes down, that if one of those hit, you could cancel the other one, so you wouldn't potentially sell twice as much as you wanted. Or SCO would be a stop close only, orders you place that attempt to trigger activating as close to the closing price as possible. A lot of funds in major market logarithmic formula-based traders do a lot of their triggering around the closing price, and SCO is an order type that tries to do that. So let's look at some examples in this case of market orders. First example, in order to buy 3 November 19 soybeans at the market is going to fill 3 contracts at the lowest asking price. So in the market depth at the bottom that I've placed where they're in red, the contracts that are offered for sale and their respective prices. In the green are orders to bid or buy at their respective prices. If this were the market depth that you were facing and the order to buy 3 November 19 beans at the market came in, filling at the lowest ask price would mean 2 contracts are going to get filled at 9.20 and a half, and 1 remaining contract for the 3 that you placed is going to get filled at 9.20 and 3/4. Example number 2, to sell 3 November beans at the market is going to fill at the highest bid price. If you were to put that order into this snapshot of market depth, to sell 3, it's going to the highest bid price means all 3 would fill at 9.20 and 1/4. Limit orders are another major order type, which are sell orders above the market or buy orders below the market. These types of orders are fundamental analysis and profitability oriented. If you are a seller or farm producer, fundamental analysis means that they're around the price forecast that you might have on what the price could do. These are also scale up selling orders. In the first example, to sell 3 November 19 soybeans at 9.50. The limit order, these are orders you place above the market. Scale up selling approach to marketing, you'd place this order when the price is below 9.50, and it's going to fill if the market trades up to it and through it. These are the types of orders that might be open offers to sell that you would place with your elevator where you deliver. The second example, I said buy orders below the market. In the second example, buy 10 November beans at 8.75 would be placed when the market is above 8.75. These would be scaled down buying type of orders you would place, and they would fill, in this case, at 8.75 if the market traded down to it and through it. Stop orders are what I would call the third major order type. In addition to market orders and limit orders, they're not as common as market and limit orders, but they do have their place. These would be sell orders you'd place below the market and or buy orders that you'd place above the market. These are more technical analysis oriented in looking at charts and where price has gone, predicting where it will go based on the momentum in orders and buying and selling that occurs at price thresholds by looking at a chart. It's also trend following oriented. In the first example, to sell 3 November 19 soybeans at 8.80 stop would be an order you'd place when the price is above 8.80. So say the price is at $9 currently. To place a sell order at 8.80 stop is an order that would become a market order if the market traded to 8.80 or lower. This is an example of creating a trigger below the market that you are not going to sell if the market stays above it or would attempt to move higher. That's why I said trend following. It attempts to follow the trend or stay with the trend higher until or unless the trend would start to move the other direction. Second example, to buy 3 November 19 soybeans at 9.80 stop. This would be an order you'd place when the price is below 9.80. It would become a market order to buy when the price traded to 9.80 or higher. So these attempt to stay with the trend but become an order that triggers if the price in essence reverses and starts moving the other direction. Well, no marketing presentation would be complete without its most common disclaimer, which is to tell you there's a risk of loss as well as profit when trading futures and options, and this market analysis, my presentation, not a solicitation or recommendation to buy or sell any futures contract or other security in any way. Thank you for joining me today in this market education module titled Hedging Strategy Part 2. We discussed the case for hedging with options, how that works in some different scenarios, why you might use various option strategies, why you might use options versus hedging, and we concluded with some different types of orders that you place and how those different order types can characterize your approach to hedging. Here's my contact information. Feel free to get a hold of me anytime to follow up with any questions. Thanks and have a great day.